Welcome to vTalkInsight, Risk Sentiment Daily for March 13, 2026. Middle East energy tensions have pushed oil back above $100 and helped trigger the sharpest equity pullback in weeks, raising a crucial question for portfolios. How far can this stagflation scare run? Risk sentiment has swung decisively risk-off, with global equities registering their weakest one-day performance in about a month and major United States indices all down more than 1.5%. Volatility has moved back into the high 20s on standard equity gauges, and price action shows a classic de-risking pattern, with small caps underperforming and broad-based selling across technology, industrials, and consumer cyclicals. Under the surface, positioning looks increasingly binary and revolves around the Middle East energy shock and the security of the Strait of Hormuz. Several desks warn that a prolonged closure could trigger aggressive selling across risk assets, whereas any credible move toward reopening would likely stabilize equities and credit. At the same time, the traditional playbook is not working cleanly. Classic havens like treasuries and gold failed to provide much protection in the latest downdraft, highlighting that even defensive capital has limited obvious places to hide. The Middle East energy shock and Hormuz risk now sit at the core of global risk pricing. Brent crude has repeatedly traded around or above $100 per barrel, and the International Energy Agency describes the Iran war as creating the largest oil market disruption on record, with estimates that 8 to 15 million barrels per day of supply have been knocked out by attacks on tankers, export terminals, and other Gulf infrastructure. Policy responses, so far only partly offset that hit. Coordinated releases of around 400 million barrels from strategic reserves, including a 172 million barrel United States draw, sound large, but they cover only a few weeks of lost flows through the Strait of Hormuz and are constrained by daily delivery capacity. Markets are treating these moves as temporary band-aids, not a cure. Crude remains in steep backwardation. Prices have shrugged off record reserve releases, and scenario work now openly contemplates oil at $115 to $160+ if shipping blockages persist for several months. Building on that, rising stagflation risk and hawkish rates are the second major pressure point. Persistent oil prices above $100 are seen adding roughly half to 1 percentage point to headline inflation, while shaving around half a point off growth in regions like Europe and the United Kingdom, with several estimates showing global growth trimmed by up to 0.4 percentage points and inflation lifted by 50 to 60 basis points. Markets have responded by repricing the policy path. Expectations for near-term Federal Reserve easing have been pushed out, with front-end Treasury yields rising as investors now price in less than one full rate cut through 2026 and question how much central banks can soften policy, while energy-driven inflation is accelerating. In Europe, the move is even starker. German 10-year yields have jumped more than 30 basis points since the conflict escalated. Traders are shifting from expecting European central bank cuts to potential hikes by year-end, and bond markets are increasingly treating stagflation as a central rather than a tail scenario. Alongside the macro shock, private credit liquidity stress and contagion risk are emerging as a key undercurrent. Multiple large private credit funds have reported double-digit redemption requests, prompting managers, including well-known Wall Street names, to impose caps and gates on withdrawals as retail and wealth clients grow uneasy about opaque valuations and the pace at which they can access their capital. Concerns focus on structural mismatches between daily or monthly liquidity promises and underlying, illiquid loans, many of them to software companies now facing competitive threats from artificial intelligence. Some veteran investors are drawing parallels with pre-crisis conditions, warning that stress could eventually spill into public credit as banks tighten funding lines and revalue collateral, yet so far the damage is ring-fenced, with investment-grade spreads still tight and major banks signaling limited direct exposure. Against this risk-off backdrop, robust earnings and resilient macro data remain important stabilizers for equity markets. The latest reporting season showed revenues up around 9% and earnings rising 14%, with roughly 3/4 of companies meeting or beating expectations, led by technology and industrial names that continue to benefit from secular themes like digitalization and artificial intelligence investment. Macro data tell a similar story of resilience. United States indicators such as the Atlanta Fed Growth Tracker near 2.7%, firm retail sales, and initial jobless claims holding around 213,000 all point to a labor market that is cooling only gradually, with no clear sign yet of the unemployment spike that would define a full stagflation scenario. That combination helps explain why, despite recent volatility, the S&P 500 is only a few percent off its highs and global equities remain up year to date, even as investors increasingly hedge against the tail of a more protracted energy shock. Resilient banks and investment-grade credit form another pillar of support. Primary markets remain open for top-tier borrowers, illustrated by record-sized transactions from companies like Amazon, and spreads in investment-grade credit are still tight, suggesting that investors continue to view this segment as a relatively safe place to earn income while riding out equity volatility. On the banking side, recent first-quarter results show stable performance and no signs of material credit or liquidity stress, even as oil prices and rate expectations move around. Post-crisis de-risking, limited direct exposure to the riskiest parts of private credit, and solid funding profiles are all helping large banks act more as shock absorbers than shock amplifiers in this phase, though a prolonged energy and growth shock could still see credit conditions tighten from here. The final constructive theme is the role of defensive equity sectors and energy winners. During the latest sell-off, energy, utilities, and consumer staples were the only S&P sectors to finish in positive territory, highlighting a clear rotation toward more defensive, cash flow stable parts of the market and toward those that directly benefit from higher commodity prices. In Europe, a similar pattern is visible. Defensive groups such as utilities and healthcare are preferred, while energy-heavy indices like the FTSE find support from elevated crude, and defense and security names are seeing upgrades as governments lift military spending, with companies such as Leonardo raising full-year guidance on stronger, higher-margin defense electronics demand. These pockets of relative strength do not offset the broader risk-off tone, but they are increasingly important for understanding dispersion within and across regions as the energy shock and inflation narrative evolves. To sum up, global risk sentiment is firmly in risk-off territory, anchored by the Middle East energy shock and a jump in perceived stagflation risk, while private credit liquidity strains add another layer of uncertainty. Set against that, solid earnings, resilient growth data, strong bank balance sheets, and ongoing demand for high-grade credit and defensive sectors are helping to prevent a disorderly unwind, even as volatility stays elevated and outcomes hinge on developments in the Strait of Hormuz. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.